Today, we're going to talk about something that might just be the single most important topic in trading, yet it's the one most people get wrong. What is it? It's not finding the perfect entry. It's not some secret indicator, and it's not about having a crystal ball. It's risk management. I know, it doesn't sound as exciting as a 100x trade setup, but stick with me. Because this is the stuff that actually separates consistently profitable traders from the 90% who lose money and quit. Think about it. How many times have you found a great trade? It started moving in your favor. You felt like a genius. And then it reversed, blew past your entry, and you ended up with a huge loss. Or maybe you had a series of small wins, got overconfident, put on a massive position, and then one bad trade wiped out all your profits, and then some. If this sounds familiar, you're not alone. This is the classic story for so many traders. And here's the big secret. Most traders, actually lose because their entries are bad. Seriously, you could probably throw a dart at a chart and have a decent win rate. The real reason traders fail, the reason accounts get blown up, is because they have absolutely no idea how to properly manage risk. They risk too much. They don't have a plan for when a trade goes wrong, and they let their emotions take over. So, let's break this down. What does risk management even mean? In simple terms, it's about defining your risk asterisk before asterisk you even enter a trade. It's about deciding exactly how much you are willing to lose on a single trade if you wrong, and sticking to that decision no matter what. This isn't a suggestion. It's a non-negotiable rule. The pros live and die by this. The most common and effective way to do this is by using the 1% rule. It's simple. You never risk more than 1% of your total account balance on any single trade. Let's say you have a $10,000 account. 1% of that is $100. That's your maximum loss per trade. Not $200, not $500, and definitely not $1,000. $100. Why is this so powerful? Because it makes you invincible. Well, almost. Think about it. If you're only risking 1% per trade, you would need to lose 100 trades in a row to blow up your account. 100. If you're losing 100 trades in a row, you have a much bigger problem than risk management, and you should probably stop trading immediately. But for most strategies, even a basic one, that's just not going to happen. This rule protects you from yourself. It takes the emotion out of the equation. We've all felt that panic when a trade goes against us hard. You start thinking, oh, it'll come back. I'll just hold on a little longer. That's called hope. And hope is not a trading strategy. By setting your stop loss based on your 1% risk asterisk before asterisk you enter, you've already accepted the potential loss. It's a calculated business expense, not a catastrophic failure. Now, let's talk about how to actually calculate this. It's not just about saying, I'll risk $100. You need to combine this with your stop loss placement. Your stop loss should be placed at a logical level on the chart, maybe below a recent swing low for a long trade, or above a swing high for a short. It shouldn't be an arbitrary number. So, once you know where your stop loss needs to go, you measure the distance from your entry price to your stop loss price. That distance, in points or pips, represents your risk on the trade. Your job is to adjust your position size so that this risk equals 1% of your account. Let's do a quick example. Again, you have a $10,000 account, so your max risk is $100. You want to buy a stock at $100, and you decide your logical stop loss is at $98. The risk per share is $2. To figure out your position size, you simply divide your max dollar risk by the risk per share. So, $100 divided by $2 per share gives you 50 shares. That's your position size. If the trade hits your stop loss at 98, you lose $2 per share on 50 shares, for a total loss of exactly $100. See how that works? You've perfectly controlled your risk. What most beginners do is the exact opposite. They pick a random position size, say 100 shares, because it feels right. Then they see the trade go against them, and they start panicking about where to put their stop loss to avoid losing too much money. They're working backward, and that's a recipe for disaster. Always, always, always determine your stop loss level first, Then calculate your position size based on your 1% risk rule. Another huge part of risk management is the risk-to-reward ratio. This means comparing the amount you're risking to the amount you stand to gain. A good rule of thumb is to only take trades where you can realistically make at least twice what you're re-risking. This is a 1-to-2 risk-to-reward ratio. Why is this so important? Because it means you don't have to be right all the time to be profitable. Let's do the math. Imagine you take 10 trades. You're risking $100 on each trade, and your target is $200 in profit. Let's say your strategy is ... Well, not great. You only win 4 out of 10 trades. That's a 40% win rate. On your 4 winning trades, you make $200 each, for a total of $800. On your 6 losing trades, you lose $100 each, for a total loss of $600. So, $800 in profit minus $600 in losses. You're still up $200. You were wrong more often than you were right, but because you managed your risk and targeted a good reward, you still made money. This is the holy grail of trading. This is how professional traders stay in the game for years and decades. They aren't right 90% of the time. They are just incredibly disciplined about cutting their losses short and letting their winners run. They treat trading like a business of probabilities, not a casino game of guessing. So, how can you start implementing this today? First, calculate your 1% risk. Know that number by heart. Second, before you even think about hitting the buy or sell button, identify your logical stop-loss level on the chart. Third, calculate the correct position size that keeps your loss at or below that 1% if your stop-loss is hit. There are plenty of free position size calculators online if you need help with the math. And fourth, only take trades that offer a potential reward of at least twice your risk. If a trade setup doesn't meet all of these criteria, you simply don't take it. You just wait. The market will always be there tomorrow, and there will always be another opportunity. Patience is a virtue, but in trading, it's a financial necessity. Having a great risk management plan is like having a superpower. It allows you to survive the inevitable losing streaks, protect your capital, and stay in the game long enough for your winning edge to play out. Stop chasing miracle entries and start focusing on what really matters. Stop asking how much can I make and start asking how much can I lose. If you can make this mental shift and apply these simple risk management principles with unwavering discipline, I guarantee you will see a dramatic improvement in your trading results. You will move from being part of the gambling crowd to being part of the professional few. Thanks so much for watching today. I really hope this helps clear things up and puts you on the right path. If you found this video valuable, please give it a thumbs up. And don't forget to subscribe for more content to help you become a smarter, more profitable trader. Drop a comment below and let me know what your biggest struggle with risk management is. I read all the comments and will try to help out. See you in the next video.